Hey, what is going on, everybody? Welcome back to the channel. In this week's Housing Market Brief, we're going to talk about the strength of the consumer. We're going to touch on student loans and how they impact purchasing power for the borrowers. And then we're going to talk about housing stats, what is going on with the wild roller coaster that is mortgage rates, and then how it impacts buyers and sellers. So we have a lot to cover here today. Let's go ahead and jump right into it. So first, we're going to talk about the consumer. Now, are consumers actually stretched to their borrowing capacity? That is the big question here. A lot of people will say that they are, but if you take a look at this chart, we're sitting at pre-pandemic levels for a couple different items. First and foremost is the credit card utilization. So right now we're sitting at about 22%. Pre-pandemic, that was averaging 24% according to this line. So on average, the credit card utilization there is a little bit less than what we have seen in prior years. Now, at the same token, pre-pandemic home equity was sitting at or above 50%. In fact, it was averaging about 51%. So overall home equity is going down slightly. It's sitting at 38%. But 40% in equity in a home is still a tremendous number. It's the difference between what is owed on the property and what the value is. And having 40% equity is still a very strong position to be in. Now, here's another chart that I found very interesting. A lot of people are talking about credit card debt being at all-time record high, which is absolutely true. That's this red line here. You can see that the credit card debt levels are the highest they've ever been. But if you look at it as a percentage of disposable income, we're currently sitting at just over 6%. And if you were to draw a line from here going all the way back, you can see that this is actually lower than pre-pandemic levels, and it's well below the 9% that we saw from the year 2000 leading up to the great financial crisis in 2009. So in other words, in real terms, our credit card balance is lower than they have been in a while, and is the consumer really as strapped as we keep hearing? Now, at the same token, we're seeing the personal savings rate down, sitting at about 3.9%. If you were to just draw a line here, you can see that's the lowest it's been in several years. And so this begs the question, is the consumer starting to get pinched? Are they depleting their excess savings? And are they less likely to continue to save moving into the future? And will that increase the credit card utilization and the credit card debt moving forward? All right, let's go ahead and switch gears a little bit here and talk about student loans and the impact it has, not only on goods and services, but it also has an impact on the purchasing power for buyers in today's housing market. So according to Bankrate, they look at which generation has the most student loan debt. Well, Gen Z is making up about 28%, Gen X is 21%, Millennials is coming in at the top spot at 43%, with an average balance just under about $43,000. So this is actually pretty substantial. If a borrower carries a balance of about 40 grand in student loan debt, you can figure that the average payment on something like this is going to be about 1% of the balance. That would put a payment at about $400 per month. And in lending standards, that absorbs about $800 a month in income. Now, the millennials make up one of the larger cohorts, and they are at prime buying age for housing here in today's market. So I believe this will have an impact in their ability to qualify for mortgages, but I don't know whether or not it's going to make a dramatic impact on the economy. I've seen things on both sides of the fences. Some folks are stating that millennials are some of the highest income earners. And so what they can do is just redirect some of that disposable income rather than maybe going out a few times a month to eat. They can cut back on that and redirect it towards their student loan payments, while others are saying millennials have so much debt at this point that this extra $400 a month in payments will send them over the edge and create several bankruptcies. We'll see. All right, now we do have the median home price is up 3.1% year over year. It's sitting at about $372,000 or just north of that. You can see that on the month, it's actually down slightly. We've started to see it taper off as things have cooled down. Now, mortgage rates have gone up. We're going to talk about that here in a second, but according to the Mortgage Bankers Association, mortgage applications are actually down about 1.3%. This is not an all-time record low, but it is just slightly off the low that we saw just a couple months back here. Median asking price is sitting up 4.4% year over year. It's just over $387,000. Pending home sales are down 13% year on year. They are following a similar trajectory to the prior years. This is a pretty standard seasonal shift as we go into the winter months. So I do expect that we'll continue to see these pending home sales fall through December and maybe tick up a little bit in January and February of next year. Inventory levels, on the other hand, have rose slightly. They are up 0.1% year on year, bringing total housing inventory to about 3.2 months. So it's ticking up slightly, although we are still in a very, very strong seller's market at this time. I think what is taking place here is that the combination of higher mortgage rates and the lack of supply and the fact that prices really aren't coming down, it's creating inventory to just sort of pile up. So we're seeing longer days on market and we're starting to see a little uptick in inventory. Now, mortgage rates are the big story here in the news. This is the 10-year Treasury yield. This is where we were last week, sitting at 4.542. We are up to 4.685%. In a week's time, this is actually a pretty dramatic move. Mortgage rates tend to track the 10-year Treasury yield very closely, which is why I wanted to point it out to you here in today's chart. That increase in yield is actually bringing the average 30-year fixed rate mortgage to 7.83%. This is the highest level that we've seen since October of 2000. That's according to bankrate.com. Based on the direction they're headed, we are on track to see 8% plus mortgages by next week as Treasury yields break above the 2008 highs. That is going to bring housing payments to the highest level that we have seen here on record. It's bringing it to just under $2,700 per month. And that's not accounting for rates being as high as they are today. So as we go into next week and they update mortgage rates here, we're likely to see this figure break $2,700 per month. And that is up 8.5% year over year here, according to Redfin. Given the dynamic we are seeing in the housing market unfold, and which is to say high housing prices, low levels of inventory, and increasing mortgage rates, we are actually starting to see the number of listings with a price drop actually increase. We're sitting at about 6.5% of all listings are seeing price reductions at this time. This is probably not the peak at this time. I would imagine if the trajectory continues, then going into November and December, we're going to see this number increase slightly here. So what does this mean for home sellers? Well, according to Redfin, pricing your home right is a delicate science. Even though demand is relatively low, you're likely to find a buyer who will pay a fair price. That's because there are so few homes on the market, with the total inventory down 15% year over year. But with monthly payments at an all-time high, buyers are going to be very, very picky, and they don't want to pay a dollar more than they absolutely need to. So they will be negotiating relentlessly with sellers. And so the advice that they give here is be careful not to price too high, or you may be forced to cut your asking price to attract a buyer. And then what does this mean for the potential home buyer? Well, it is time to negotiate with the sellers. It's still tough to win a home for under asking price, but sellers have come to the terms with the fact that a 7% plus mortgage rates are giving buyers cold feet, and that homes aren't as likely to attract multiple offers. So many sellers are open to making concessions, and that includes things like paying for repairs or helping fund mortgage rate buydowns. All right, and that is going to wrap it up for this week's housing market brief. If you found any value in this whatsoever, please consider hitting that like button, subscribe to support the channel. I would greatly appreciate it, and we'll see you on the next video. Thank you so much. Take care.